I think that there's what you've got here. There's the question here is how far is Disney prepared to go? So a Fox stroke Disney, if you want to call them like that, prepared to go in order to actually beat Comcast, because Comcast has shown a willingness to actually come back and increase its bid. And obviously, the questions then become about the leverage that both companies can actually take on their balance sheet. I think there's an argument here for saying that for Comcast, Sky is probably more important than it is for Disney. I think in terms of Comcast, it's stated a desire to actually expand its revenue streams outside of its core businesses in the States. Whereas I think for Disney, the interesting thing here, and obviously Comcast knows the distribution business already, I think for Disney what's very interesting is if you look at their actions certainly in the US suggest some wariness about the future of the traditional pay TV model. And yet here they are looking to buy a traditional pay TV model in a different market. So my feeling is that always taking the view that probably Comcast will be the eventual winners of Sky because it probably makes more sense for them.
Is it really just about the money, though? Because, as you noted, Ian, Comcast are still in pole position with £14.75 a share bid. Begs the question, what does Disney-backed Fox bring to the table to support its offer in terms of synergies, etc.?
Well, it's interesting because if you look at the pay TV model, there's actually not a huge amount of synergies that you would gain across the particular assets. You could argue, for example, well, surely there may be some content synergies. Well, maybe, but the point being is that whatever Sky, as it were, would save in paying for Disney would lose out in terms of revenues that it gets for Sky. There are softer things that you can bring, for example, best practice and so on, but when it actually comes to a pay TV operator, if you take something like Sky, for example, roughly around 60% plus of its costs are programming costs. There's not really a huge amount that you can do because you look at the components of that, the main things are things like sports rights, and they tend to be sold on a geographical basis. Then you're looking at movie costs, which again, there's an argument not really for saying that there could be much synergies there because again, it's still on geographical costs. And then you're looking at localized content. So quite frankly, I don't think there's going to be a huge amount of synergies from this deal. And to be honest, it would be the same for both Comcast and for Disney, so that neither of them would expect this to be a mainly synergy-driven deal.
OK, does it help Disney's case that they already own Fox's current 39% stake in Sky? So it begs the question, what's the rationale for acquiring the rest of the company? And is it to help Disney launch the streaming service in Europe?
Well, you have 100% control of it, so you have 100% control of the cash flows, you've got full control of the strategy, and so on. I mean, it's an interesting scenario. I mean, you've got Comcast, presumably with its higher bid, would get the other 61% of Sky that Fox doesn't own. What does Disney do? Does it want to remain a 39% minority shareholder in this? I think the other thing which has always been at the back of people's minds with this bid is, how much is this just a fight for Sky, or is there a wider strategic picture being painted here? I.e., does Disney say, well, you as Comcast can have the assets here in terms of Sky, but you know what? Maybe we want you to exit Hulu in the US, and we take that stake and take majority control, and leave us to the rest of the Fox assets, which is pretty much, if you look at what's happened, Comcast has withdrawn its bid for the other remaining Fox assets. So I think for Disney, the feeling would be is that Disney probably has less strategic need for this asset, and probably there's less of a strategic rationale given some of their actions and comments than there is for Comcast.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.